Good day, Market Chameleons, and everyone joining for the first time. Thanks for coming by and checking out the Market Chameleon live webinar series. Before we get started, let's take a look at the share disclaimer. Please be aware that neither Market Chameleon, Dimitri, or myself are registered investment advisors or broker-dealer. If you're searching for investment advice, please reach out to a licensed professional. This webinar, as all our webinars and shows, are for informational purposes only concerning Market Chameleon tools and products. With that, one last look at the disclaimer, and let's welcome Dimitri Pargamonic to the stage, who's going to be talking about screening for call spreads using liquidity metrics. How are you doing this morning, D?
Good morning, Will. How are you?
Great. Let me share your screen. There's the Market Chameleon landing page.
Good morning, everyone. First, let's navigate to the call spread, and then we'll take a look at some liquidity metrics we could use to screen for call spreads. So up top, under screeners, we're going to go to the right. Let's look at a bull call spread. So I'm going to click on that. This takes us to our bull call spread screener. As you can see, we have the filters up top with different tabs. We also have a data table below, and this also has different tabs showing different metrics and analytics for particular spreads. And when we look at call spreads, just quickly, we're looking at a option strategy that involves two legs, buying a call on one strike, selling a call on another higher strike in the same expiration. So when we go from left to right, we'd identify over here the symbol, stock price, market cap. These are some analytics based on the price and value. These are the call spreads that we're analyzing. So here, this is the November 21st, 195, 200 calls. Buying the 195 call, selling the 200 call in November 21st. That's a bullish call spread. So what we want to do in this example is narrow down potential spreads based on liquidity measures. The idea there is if we're looking for potential call spreads to analyze, we want to narrow down where there is trading interest, where we could detect that there has been trading activity, there's volume, perhaps open interest, perhaps tightening in the spreads, and that gives us the opportunity to trade something that could offer an opportunity for better price execution, opportunities based on valuation, where the markets have moved. So to do that, okay, well, before we do that, I'm going to first go to the tab which shows us that data. So we're going to go on volume analysis. Okay, and here the data table, you can see we still have the NVIDIA. These are the spreads. And here we see the volume that's traded on a day. So we have two strikes, right? We have one on the buy strike and one on the sell strike. So this is the volume on the day, 4,993 options traded on that 195 call. We also have open interest, 31,075 on that. This is the volume on the other option, the sell strike, 200, 16,459. This is the open interest, 79,385. So this lets us see the trading activity and trading interest and open positions on these particular options. Right now we know that, yes, these options have trading interest. They traded on a day. They have open interest, so they're positions being carried and they traded in the past. So that signals to us that there's already liquidity in trading in those options, right, which could offer opportunities. And if I'm going to sort it, you could see not every NVIDIA happens to be very busy. This is sorted by house market cap, But if we just sort by any one of these columns, like let's say over here, here you see AAOI, and here's a spread that's we're looking at, but it had 0 volume on the day in this option. It only has 240 contracts open interest. This one had 13, a volume of 13. So November 21st, 32 call traded 13 contracts. It's not much with an open interest of 81. So there's a lot less trading interest, a lot, barely zero on the day in one of the calls, 13 contracts in the other. These could be less liquid. Price discovery could be more foggy because we don't have historical trading to reference. So less liquidity, right? There's less liquidity in this particular option. Now, we could also sort, right? Or filter. So what I'm going to do is let's expand the expirations we're looking at. So what I'm going to do is go to the expirations and look at all expirations that expire within the next 30 days. So this isn't only looking November 21st, but it'll look at different expirations that expire within the next 30 days. So I'm going to come back here, go back to filtering by market cap. Okay, so click on market cap. This will refilter. You see we have 104,000 different spreads in here that we're analyzing. So I'm going to go back to highest market cap. And this will bring back the NVIDIA, 4.4 trillion. And here you see we have October 24th expiration, October 17th. So different expirations now with different combinations of strikes. So let's come back here to the volume. And if we want to narrow this down, we might want to use open interest and volume. Okay. So to do that, we could let's just set minimum open interest. Let's do over 10,000. Okay. On the buy strike. So if we do that, you'll see this from right now, we have 104,000 different spreads. This should narrow down. So now we only have 1,200. So you could see how quickly that goes down. So that's just on one option alone. If we require 10,000 open interest contracts, that went significantly down, from 104,000 to 1,200. Let's do it on the sell open interest. Over 10,000 now on this side. Now we're down to 308. What if we require certain options on a day? We want to know that not only is there an open positions people are carrying and there are trades in these options previously, but we want to know, are there trades happening today? Which allows us to participate perhaps in that trading activity. So we could set today's volume. So let's just say, let's go over 1,000 on the buy side. So let's see how much that brings us down to. So now we're at 265. Let's do 1,000 on the sell side. So that will bring us down from 265. Let's see what that does. Now we're at 248. Okay. We could also bring it down even further by saying not only do we want to cease trading activity in both legs, but we want to see that this particular spread traded. Okay, so that's where this comes in, multi-leg. This is looking at where the spread itself, October 31, for example, 185, 190 spread, we detected traded as a spread. Okay, because now we could reference the prices it traded at, the relative price to the display bid and offer, where the reference stock price was. We could go and look how many times the spread traded and the volume. So let's say that this multi-leg traded as a multi-leg, the volume has to be at least 100 or more in a day. Okay, so at least this spread had to trade at least 100 times on the day for us to go and look further. So I'm going to click on this, and now we're going to go from 248. Let's see what it comes down to. 112. So now we're at 112. So Nvidia happens to have a bunch, Apple, Google. So the popular ones, or the more busier ones, not surprisingly, will have more. And we could tab through these. Here's page 2, Amazon, Tesla, SPY. Okay, so you could see here, this is the times it traded. For example, GOOGL, Google, the October 17th, 247.5, 250 call spread. So right now the ask price is $1.90. Right, so that's the ask side. But it traded, the last time it traded 1234.47. The VWAP price on the day, volume weighted average price is 210. So now it's offered below that. The bid and offer at the time were 190, 233. So we could see it's trading in between, closer to the offer, with a reference price of 253.54. So you could see the stock was down, from that. Okay. So now we have these reference prices in front of us. Makes it much easier than to kind of figure out what's going on, what's trading in there, where did the spread trade at what prices relative to the bids and offers, where were the reference prices in the stock, how many times it traded, the volume. So you see this one, for example, in Amazon traded a total of 19,640 contracts in this particular spread. Okay, for 64 cents. Right now it's offered at 15 cents. Okay. We also maybe want to see where there's leans in the spread. So lean, this is the lean. And the leans, what it says is that the spread, the bid-ask spread, looks like it's tightening up, either on the bid side, the sell side, or both. And it's tightening up relative to the surrounding options, right? So we're looking at it where we could figure out the implied volatilities. The bid-ask spreads are the last time we took a snapshot, they're tightening up. So we could look at, for example, if on the sell strike, right? So the strike that we're trying to sell, we might want to look for a bid lean, right? Because if we're trying to sell something, we want to see if there are buyers willing to pay higher. So we might look for a bid lean. Let's see how much it takes us down. So let's see if it goes from 112 to 11. So you can see here that the sell call, there's a bid lean, right? That means that this strike, the 225 strike, looks like that the spread tightened up and it was on the bid side. Okay, because when you tighten up a market, let's say you're $1 to $1.20. Well, if somebody puts in a bid of 110, well, they tightened up the market, right? They tighten now we're looking at 110, 120 instead of $1 to 120. Well, we have to figure out, which was the side that tightened it up? Well, the bid side, right? Because the bid went from $1 to $1.10. They raised the price to tighten that market. That's what this means. Okay. So we're looking at the selling strike call 225. There's a bid lean. On the other side, we could look for an ask lean. What about the strike we're buying? Well, we could say, show me an escalene. What this would look at is say, well, if we're looking at the spread, originally is, let's say, $1 to $1.20, and somebody puts an offer at 110. So now the market is $1, $1.10. Well, it tightened up, and it's important to know, well, which side did it? It was the ask. So now we're down to just 3. Okay, so we put all these liquidity measures in to potentially look at 3 spreads to analyze where we see there's liquidity, there's trading activity in both legs, there's open interest in both legs. These spreads themselves traded on the day, at least 100 option contracts. So we see the reference prices. Where were the prices they traded at? What were the markets at the time? Where was the stock? How does that compare to the current markets? We also see that there's currently, right, from our last snapshot, more interest indicated by traders by bringing in the markets, tightening the markets on both sides of those options. So these are ways to use these liquidity metrics, right, to narrow down potential choices, right, to look at. Now, besides looking at the bid and offer, sometimes you have a lean on both. So let's say a lean on both would look like this. The original market was $1 to $1.20. Then somebody offered for $1.15. That's a lean on one side. And the other side raised it to 105. So now we have both sides indicating they're willing to negotiate for better prices. So that is where we have both. Okay. So that could be good too, because it's shown there's interest on both sides of, buyers and sellers. Maybe they didn't meet, but they're okay. So we didn't find any on both for given, all these other parameters that we set. But just to show you here, I'm going to clear everything to go back to the original side. And let's say we're looking just for, let's see if we find any lean on both sides. So you can see here, now the sell strike has a lean on both sides. The bid and offer both squeezed in. Okay, so I'm going to stop right there. I think we covered, a lot of these liquidity parameters for everyone to have a good idea.
Yeah, that was super helpful, Dimitri. Thanks for bringing that webinar to the Chameleon community. It's the last webinar of the week. So you have a good weekend, my friend, and we'll see you Monday for another webinar.
Yep. Thanks, everyone, for joining. Stay safe out there. Have a great weekend and a great trading day. And
have a great day.
Monday morning.
Have a great day, D. Thanks.
Thanks.
Bye. Hey everyone, thanks for joining another Market Chameleon webinar series. If you're following us on any of the social platforms, please thumbs up, like, comment, all those good things. If you're on YouTube, thumbs up, always appreciated. If you're new to the Chameleon community and today's your first day, remember, well, you wouldn't know, but you can get to the tabs and there's always, you can take a free trial for 7 days, which is always helpful to the Chameleon community. With that, everyone have a great weekend. Watch out. You'll get emails tomorrow. We're going to be doing a weekend webinar series going forward. Those are pre-recorded webinars. You'll be getting an email. There's a link. Or if you go to the YouTube channel, you can watch them at your convenience. Those are going out early in the morning. So if you're up early, watch those webinars. Everyone have a great, safe trading day, and we will see you Monday live. Have a great day, everyone. Bye-bye.